Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, also known as Mr. Valuation. And frankly, as Mr. Valuation, I'm a very frustrated value investor today. You know, markets are at an all-time high. I believe valuations on most stocks are extended, and therefore it's very, very difficult to find value. And I've certainly been looking for it, and I found it a big struggle to find it. And, you know, most of the premier dividend growth stocks that I tend to favor right now are overvalued. It's very, very hard to find them. I have given you some examples here in recent videos. But the general overall market is expensive. And so, you know, I also like to try to do some videos for investors that are looking for total return or growth in their portfolios. And in order to do that, I finally decided I'd take a look at the mid-cap stocks, and I start screening around mid-cap stocks, and I looked for mid-cap stocks that I could find that had very attractive valuations, number one, but also had good long-term growth prospects, and that was a very important aspect. Now, one thing about mid and small-cap stocks, both, but mid-cap stocks specifically to this video, is the fact that as smaller companies, they typically have easier time growing their businesses going forward, assuming their markets, you know, facilitate that kind of growth. But anyway, in doing my research, I came up with 5 stocks that I would like to share with you today, and I call them mid-cap growth stocks. I'm going to be looking at Lease Corporation, Chemours, Jazz Pharmaceuticals, Jabil Circuits, Polaris, and Thor Industries. And these are a pretty diverse group of stocks. You can see their credit ratings range from 2 of them have investment grade ratings. Chemours and Thor are just below investment grade ratings, and Polaris doesn't have a rating at all. Now, what's very interesting about all of these stocks that I want to focus on is that if I look at their price earnings ratios or their multiples of earnings here, all of them are trading at PE ratios that are significantly less than their expected 3 to 5 year growth rates. And I really do consider that a big plus. Also, they all have earnings yields above my 6.5% threshold, which is something that I, really like. Now, 5 of the 6 pay a dividend, and only Jazz Pharmaceutical does not. But the dividends, as you'll see here as I go through these, aren't really that material. But anyway, I've put these kind of together for you because I think these are companies that you might want to all take a closer look at if you're looking for growth or total return of your portfolios. These are all pre-research. I want to be very clear about that. A couple of these companies I know, a couple of these companies I've invested in the past, and one of these companies, at least, Jabil, I did a recent video on about a year ago, so you can also look for that if you would like. But anyway, I'm going to go through these very quickly with you here. We're going to start by looking at Polaris, and Polaris is a very interesting company. If you're not familiar with them, Polaris basically builds off-road vehicles, snowmobiles, just a whole group of what I would call leisure products or leisure vehicles. And they do make some commercial government and defense vehicles for the military. They also involved in boats, and these are some of their boat brands here. On their on-road vehicles or their Indian motorcycles, the Slingshot motorcycle, and then they have some, interesting little smaller vehicles as well. And then, of course, they're really known for their off-road vehicles here. So the company is a very interesting little stock. I want to kind of go through the historical record of it here because I also think this particular company provides such wonderful lessons about valuation, but also it's kind of a quintessential example of how stock prices go where the business goes. And I talk about that all the time in my videos. And this couldn't be a better example because you can look here and see that Polaris's earnings were moderate. They grew a little bit here, but they were flat, and the stock price tracked that at around a 15 multiple. And then they went, coming out of the Great Recession, they went through this earnings spurt, and you can see the stock price, not only did it follow the earnings, but it just, as it usually does when stocks get hot and get momentum, they tend to get overly enthused about them, and the prices and the values get significantly above what I believe the true fundamentals justify. And then they hit a wall here in 2015 and 16. There were some supply issues, all kinds of things going on with the company. But the bottom line is the stock price came back to fair value. And then they went through a nice growth spurt again, which was only temporarily interrupted by COVID. And of course, you saw the stock price fall dramatically during the COVID pandemic here. What a great time to be buying the stock. And now as earnings have been continuing to materialize, the company's stock price has screamed to the upside. Trading at a blended PE of 15.29, earnings yield of 6.5, does have a nice dividend yield. And by the way, if you look at this stock from a standpoint of just its dividend growth, it's had a very nice dividend growth rate historically. Now, more recent years where they've had some of the struggles I just showed you, their dividend growth rate has slowed down a little bit, but nevertheless, it has a good record of dividend growth. You can buy it today with just under a 2% dividend yield. It's a $7.8 billion company, and I think a very interesting little growth stock. Now, this is all about the future, and all of this whole video is about the future. The trend line 3 to 5 year growth rate for this company is expected to be about 19% a year. Now, it is expected to have a weak year in 2023, and so what I like to do with that, I like to go to the custom calculator, and I like to combine the long-term growth rate, which is expected to be 19%, with the near-term estimates to kind of give you a perspective. And as you can see here, if this company does grow at 18 or 19% a year, then, the opportunity to make double-digit returns over the next 5 years or so, over 19% annualized returns is very, very strong. And even if the stock only trades at a 15 PE ratio, which has historically been its more norm, but now it's growing faster, you still got 10 to 15% rates of return that you could make in this stock. And, like any other stock that I'm recommending or not recommending, I want to be clear, I'm not recommending it at this point. I'm simply illustrating it as a potential research candidate. I would like to always be able to buy them cheaper. Obviously, this would have been a marvelous time to have been able to pick up some Polaris. The next company on the list is Thor Industries, and Thor Industries, very similar to Polaris. It's also it's called an automobile manufacturer, but it's really known for its RVs and all the different types of RVs. They make travel trailers, fifth wheel trailers, lightweight trailers. What they're most known for, I think, are their Class A motor coaches, but they also make these little expandable trailers. So it's really a outdoors recreational vehicle company that, is the world leader. A lot of growth in this company, but like during the Great Recession, I do want you to be aware of that. The company did suffer some, did struggle some. You can see, again, another classic example of how price and the business results track each other. The dividend has been very spotty on this particular company. So again, neither one of these first two stocks are really for the faint of heart. But if you catch them at the right time and invest in them when you can buy their growth, they have tremendous opportunity. Thor is expected to grow at around 24% a year. Off-roading and, motor coaching and so on is a very fast-growing pastime right now. So this stock has, tremendous growth expectations going forward. Its analyst scorecard, though, is a little spotty. I do want to make that clear. But this is one that you might want to take a closer look at as well. The next is Jabil Inc. This is a Clearwater-based Florida company. I presented a video on this before. They're involved in some very innovative and interesting electronics, I guess you would call it. They're listed as an electronic manufacturing services company. You can buy them at a PE of 12.5, which is half the market almost. Earnings yield of almost 8%. Very minimal dividend yield, and the company has a long record of maintaining their dividend, but very low payout ratios. This isn't really about the dividend. This is about catching this where you can really get the capital appreciation. You see the stock got very inexpensive. It's now got a lot of momentum going for it, and it's got good long-term growth potential. This year is still expected to be very strong and slow down a bit for the next couple years. But if I go back to the custom calculator and combine the two estimates, you can see the growth potential here and the future rates of return could be very, very enticing in Jabil. The next company is Jazz Pharmaceuticals, one of the more interesting pharmaceutical companies out there. They're involved in a couple of very important therapies. One is sleep disorders, which is something they're a leader in. Also, they're getting involved in oncology. I'm not sure how to pronounce the name of that drug, but I think it's Xywav is a very, very promising drug that they've just received approval on. They've got a very robust pipeline that gives them the ability, they believe, to generate, good, strong growth going forward. Analyst expectations are for growth to be double-digit growth for the next couple of years. The long-term trend line growth is expected to be just under 30% a year. And again, if I combine those two just to kind of get a near-term and longer-term perspective, we have tremendous upside in this company if they're able to hit all their targets. It's only double B minus rated, but it only has 32% debt. It's a $10 billion market cap company that's expected to grow very fast going forward. You might want to take a closer look at this one. And again, there's a PowerPoint presentation in here which gives you a lot of information on the company for both their neuroscience as well as their oncology products. So take a closer look at Jazz Pharmaceuticals. Chemours is a very interesting company. I believe this was a spinoff from DuPont. I want to double check that, from Dow DuPont. But anyway, it's a diversified chemicals manufacturer. A lot of their brands are, they call it world-class product portfolio, and I think you would agree. Names like Freon, which has been obviously used in all the residential, commercial, AC, heat pumps, and refrigeration. Teflon, which is a coating, that's used for all types of very important manufacturing capabilities. But they're involved in all these different, repellents and surfactants, fire suppressants. Again, I'm not an expert in any of these, but it's chemicals. But the point is, the company had a little bit of a cyclical history. It does go through very strong growth spurts. It's forecast to grow at over 20% a year just for the next couple of years. And the long-term trend line growth is over 30% a year. So this is another one that you might want to take a closer look at. If I combine the estimates with the near-term estimates with the long-term, once again, there's just tremendous amount of money to be made. But again, this company is a rather difficult one to analyze. You can see their analyst scorecard. Analysts get it wrong quite often, so it's one you'd have to pay a lot of attention to. But if you can catch it when you have these growth spurts, it might be something, if you're looking for capital appreciation, that would be worth taking a look at. And then the last but not least is Lease Corporation here. This company basically buys aircraft and leases them to airlines and governments and private individuals even all over the world. They also do fleet management and do a lot of things like that. The company's had a good record of historical growth. To try to get you a good number here, it's averaged about 14% a year. The airline industry obviously suffered during COVID, and so did the stock. It's been recovering, pre what I'll call total recovery. Earnings are expected to begin growing very fast in 2022. The long-term trendline earnings growth rate is expected to be about 17% a year, but it's also expected to grow at 36 and 28% in 22 and 23. So this is another example of a company that you could expect some very, strong growth. So these are just a really nice little group of mid-cap companies. Their market caps range from $5 billion up to $10 billion. That gives them a lot of room to grow. They're good, interesting little companies. They're kind of leaders in their respective industries. They're really not for the conservative investor. This is more of a growth-oriented total return portfolio. Buy the momentum, buy the long-term opportunity. But anyway, in this overheated market, 5 or 6 stocks here, 6 stocks for you to look at that have attractive valuations and growth rates. All of them are expected to have long-term growth in excess of their PE ratio now. And that's what, that's kind of growth at a reasonable price, if you will. Anyway, I hope you enjoyed this video. If you did, give me a like, give me a thumbs up, ring the bell, subscribe to the channel, do all that stuff for me. I appreciate it. Thanks for watching, and I'll look forward to talking to you in my next video. This is Chuck Carnevale saying thanks.